Hi everyone, welcome back to the series of videos on Ind AS, that is Ind AS with Accountsman. In the previous two lectures we had discussed Ind AS 33. Major part of Ind AS 33 was over. So let us finish off this remaining part of Ind AS 33 in today's lecture. So if you can recall, in the previous two lectures we had finished basic EPS. So today we'll discuss diluted EPS. As I told you previously, EPS will be basic and diluted. There are two parts. And we had discussed what, why, when. We were discussing how. In how also the basic part was done, and we were discussing diluted EPS. So without wasting much time, come on, let's get started to diluted EPS. Okay, what do you mean by diluted EPS? As the name itself suggests, diluted EPS means EPS going down. Earnings per share reducing. Earnings per share was previously 10 rupees, now it is 9. So that is diluted. You get that? Or earnings per share was loss of rupees 1, now it is loss of rupees 2. That is again diluted. It can be decrease in the positive EPS or increase in the negative EPS. Either ways it is diluted. Now why will there be dilution in EPS? That is the interesting part. Shall I tell you? So there are few potential shares. If these potential shares will get converted into shares, then what happens? The denominator in the EPS formula will increase. I'll tell you, there are few people who are potential to become shareholders, but they're not shareholders as of now. If they become shareholders, the number of ordinary shares will increase. If number of ordinary shares increases, the denominator will increase. When the denominator increases, earnings per share will decrease. You get that? So we have house. In our house there are 4 mangoes and we are 4 people. So if you are 4 people in the house with 4 mangoes, each of us will get 1 mango. But if there are potential guests who can come to the house, now assume that there are 4 more guests, so 4 guests who can enter the house. If they enter the house, number of people in the house will become 8 and number of mangoes are 4. So each of them will only get half of the mango. So there is decrease in the amount of mango that each person gets. So that is nothing but dilution. So I'll repeat, potential shares are those shares which can get converted into ordinary shares. They will lead to dilution in the EPS. You get that? Now the question is, what are these potential shares? Potential shares can be convertible debentures. If there are debentures issued by us and those debentures, by mentioning in the certificate, we've given them an option to convert them into equity shares. Definitely not at the beginning, definitely at the end of a certain period of time. So then such convertible debentures will become, or to say, potential equity shares. Next one is convertible preference shares. Now there are certain preference shares wherein by virtue of the preference share certificate, we have given them an option to convert their preference shares into equity shares. Like till yesterday they are preference shareholder, today they are our equity shareholder. Possible or not? The answer is yes, it is possible. Why? By virtue of the share certificate. The certificate that I gave him on the day he joined my company, I have given there. You have an option to get converted into equity shareholder. I have given it. So if he exercises that option, he becomes my preference shareholder. So he is a potential shareholder. Next thing, we have employee stock options. Now, we give certain employees certain options, no? Like if they are with us for a specific vesting period, at the end of that vesting period, I would grant him some options which he can exercise during the exercise period, and he can become the shareholder to the extent of certain shares. So if such options are given, those options are potential shares. They can get converted into shares. So they are also potential shares. You get that? Or if there is any other options or warrants. Or if there is any other options or warrants, or if there is any contracts to be settled by issue of shares. That is not BUY, that is BY. By issue of shares. Now there are certain contracts. It might be purchase sale contract, trade contract, or it might be service agreement, or it might be another contract. I have entered into such contract, and as a consideration in that contract, I have agreed for non-cash consideration. What is non-cash consideration? Now you've taken some service from them, or you've taken certain goods from them, or maybe fixed asset from them, and in return I'm not going to give them cash. I'm going to give them assets, or I'm going to give them shares. So I promised, you give me this machinery, I'll give you shares in return, or you give me these goods, I'll give you shares in return, or you give me this service, I'll give you shares in return. So I have agreed to such contracts, and that contract is not completely executed. That party has also to render the service yet, is supposed to give me the goods yet, is supposed to pass on the asset to me yet. So he's supposed to do that. If he does, I might have to give him shares. So that is a potential share there, because if the other party complies with those terms in the contract, then I might have to issue shares to him. So it will become what? Potential shares. So these potential shares, what will happen is they eventually get converted into shares. If they get converted into shares, there will be a decrease in the EPS. Such expected decrease in the EPS, I'll repeat, listen, expected EPS decrease. Expected EPS decrease on conversion of potential shares to shares. On conversion of potential shares to shares, what will happen? It will be decrease in the EPS. That is called as diluted EPS. I hope you got the point. Now, these potential shares, whatever are there, these can be categorized into two categories, two broad categories. I am talking about these potential shares. One of which is dilutive, other one is anti-dilutive potential shares. Dilutive potential shares. So what do you mean by dilutive? What do you mean by anti-dilutive? If this potential shares, when get converted into shares, if it decreases the EPS, then it is dilutive. If it doesn't decrease the EPS, it is anti-dilutive. I'll repeat. If EPS decreases on conversion, it is dilutive. If EPS increases on conversion, then it is anti-dilutive. I'll repeat. If EPS decreases, it is dilutive. If the EPS increases on conversion, that is potential shares becoming ordinary shares, then it is anti-dilutive. And we need to consider only potential shares considered in diluted EPS calculation. This part is always ignored. Ignore. You get that? Anti-dilutive potential shares are always royally ignored, never ever used in the computation. Only dilutive potential shares, whatever are there, I'll repeat, only dilutive potential shares, whatever are there, is always considered in diluted EPS computation, because the name itself says so. You get that? Now let us see how does it work. We have, okay, I'll write it in the same color. We have potential shares, and as I told you previously, these potential shares can be dilutive, can be anti-dilutive. Now the question is, when will it be dilutive, when will it be anti-dilutive? I told you some generic information there. I will talk a little more specific thing. Okay, if it is with respect to convertible debentures, let's talk some specific cases. If it is convertible debentures and those convertible debentures are low debt, then it is dilutive. If it is high debt rate, then it is anti-dilutive. Now what is this low debt rate and high debt rate? Now the interest that is supposed to be paid on these debentures is very low. is very low. In fact, when I say low, it should be lesser than EPS rate, or it should be lesser than the cost of equity. Or if I have to tell you, cost of debt is lesser than cost of equity. You get that? So paying interest is less. If they become equity shareholder, you'd have to pay them more profits. So then it is dilutive. Other way around, if the debt rate was more, interest rate is like sikapate high. Whereas when they become equity shareholders, the market is very risky, so the return expected is, the market is different and the return expected is very less. Then what will happen? The cost of debt is more and the cost of equity is more. If we convert him from debenture holder to equity shareholder, then our earnings per share will increase because the amount of debt rate that we are paying is very high. So if it is low debt rate, it is dilutive. If it is high debt rate, then it is anti-dilutive. Now this with respect to convertible debentures. Now what about convertible preference shares? We need to check how much is preference dividend. Now preference dividend plus the dividend distribution tax. The preference dividend plus, if it is not there, means say the subsequent years onwards, as our Srimati Nirmala Sitharaman ji basically announced in the previous budget, saying that DDT will no more be existent. So then we'll not take DDT into consideration. But till the time DDT is there, we'll take DDT into consideration. This preference dividend plus DDT, if it is lesser than earnings per share, then it is dilutive. On the other hand, if preference dividend plus dividend distribution tax is greater than earnings per share, then it is anti-dilutive. How does this work? Now preference dividend plus DDT is something that you need to pay to your preference shareholder. But if you convert that preference shareholder to equity shareholder, you need not pay him anymore. He will be part of your EPS. You would have to pay him normal, let's say ordinary shares ka dividend. So in that case, what happens? That preference dividend need not be paid and is eligible for EPS. If your EPS rate is more, then it is decreasing your EPS. Because the preference dividend rate was less, you could have paid him less and then closed. Now you have to pay him more. So that decreases the amount of money that goes to each ordinary shareholder. That is dilutive. On the other way around, vice versa. If you're supposed to pay huge amount of money to your preference shareholder, now he being lapsed as being his preference share being lapsed and he becoming ordinary share will give you a savior here. Will help you or will save you from paying that high preference dividend. Then there will be increase in the profits. There will be increase in the per share EPS. So basically earnings per share. So that is anti-dilutive. However, with respect to options, warrants, it will have no impact on our dilutive, no? It will have no impact on the income, isn't it? So it will be usually dilutive and it will not be anti-dilutive. However, you can check it as the case basis and then we can take it options, warrants, as well as contract settled by other than cash medium. So those will always be dilutive. Now let us see how do we compute dilutive EPS. Is computed like this: earnings available to ordinary shareholders if potential shares are if dilutive potential shares. Anti-dilutive potential shares are not considered. If dilutive potential shares are converted to shares, yeah. So the numerator is this: earnings available to ordinary shareholders if potential dilutive shares are converted to shares. This will be divided by weighted average of ordinary shares plus weighted average of potential shares. So in the numerator, what we do is we take the earnings as if those potential shares are converted to ordinary shares, what would be the profit? We recompute the profit here. We are not taking the profit as per basic EPS. We are recomputing the profit as to how much will it be if those potential shares are converted to ordinary shares. So we take that profit, we divide it by the denominator. The denominator will include the ordinary shares that we had previously plus we'll have those potential shares, and both are to be taken as per the weighted average. Now with regard to weighted average, we know how to take weighted average for ordinary shares, but the very interesting part is weighted average for potential shares. It is considered, and the time for which this weight is computed is, it is as if those potential shares were converted to shares at the beginning of the period. Yeah, time is from the beginning of year. What does it mean? That is, assume potential shares are converted to shares at the beginning of the year. So at the beginning of the year only we are converting these potential shares to shares. So that's what we assume when we compute our diluted EPS. Now I told you a lot of potential shares, no, debentures, shares, ESOP. So we'll see it case to case basis as to how will it impact our diluted EPS. So we'll discuss it with regard to our numerator as well as our denominator. So let me run you through convertible debentures, or basically any loan or debt instrument, or basically convertible debt instruments. Yeah, and then here we'll take convertible preference shares. Both look similar, so we'll take both the cases together, and later we'll take our ESOP. So firstly we'll discuss our convertible debentures or convertible debt instruments. Yeah, okay. So I'll write here after conversion, and this will be before conversion of potential shares to equity shares or ordinary shares. Now we'll have earnings before interest and tax in both the cases. That will be same, no problem. And I'll do less interest. This interest will be on the debt instruments. So interest would exist here before conversion. After conversion, interest would not be there. After conversion, when you converted those potential shares to ordinary shares, there are no more debt instruments. When there are no more debt instruments, you need not pay interest anymore. So the interest will be zero here. Okay. After this, if I draw a line and I write earnings before tax, it would be there in both the cases, but they would not be same. In this case, it would be equal. In this case, this is more, and as we've deducted, our after conversion earnings before tax will be more than the before conversion earnings before tax. Let me continue. I'll deduct tax in both the cases, after deducting which I'll arrive at earnings after tax. This is, I'll take this as earnings after tax to ordinary shareholders. I'll write this as EATOS. You remember, earnings after tax available to our ordinary shareholders. So this exists in both the cases. What we need to note is tax would be more in this case, and even after tax I think our earnings after conversion will only be greater. And in the computation of basic EPS, I'll write here. In the computation of basic EPS, this will be considered. In the computation of dilutive EPS or diluted EPS, we'll consider this. You get that? The computation of basic EPS will take before conversion one, and in the computation of diluted EPS will take the after conversion one. This is not like actual conversion, assumed. Like if converted, what would be the profits available to ordinary shareholders? That's what we compute here. So this is something that we understood with respect to convertible debentures. Now let us see what will happen with respect to convertible preference shares, shall we? So again, I here also I'll write before conversion, and I'll also write after conversion. Yeah, I'll have earnings before interest and tax. In both the cases this will exist, and we'll also do less interest. Let us assume that these interest ka debt instruments are not convertible in nature. Yeah, then our earnings before tax will come, and let me tell you, this will be same and there will be no difference, and I'll do less tax amount will also be same. Yeah, then I'll go to earnings after tax, this will also be same. Now comes the part less preference dividend. Before conversion there will be preference shares, so you have to pay preference dividend. After conversion there would be no preference shares and you need not pay preference dividend. Why? Those preference shares are right now your ordinary shares and they will take part in EPS. They will not take money like preference shareholders. You get that? So what happens in this scenario is, I need to write one more, isn't it? Earnings available to ordinary shareholders. That would exist in both the cases, but in after conversion case that will be little more. You get that? Yes. So this will be used in basic EPS. We've known this for all the time now. Whereas this will be considered in diluted EPS. This will be considered in diluted EPS. You understood what I'm trying to tell? So diluted EPS will be little more than the basic EPS ka numerator. I'm not talking about diluted EPS. The numerator part will be little more in the case of diluted EPS than basic EPS. You get that? So we'll be considering this in case and this in case of diluted EPS and not this. This part will be in case of basic EPS. However, we discuss the numerator now. What will be the case with respect to new denominator? With respect to denominator, whenever I told that it will not just include weighted average of old shares or ordinary shares, it will include weighted average of potential shares also. Now, it might be a case where in case of convertible debentures, I have told one debenture I will give you 2 or equity shares, or maybe case like 10 debentures के लिए 1 equity share. Okay, possible. 10 debentures के लिए 2 equity shares. So this 10 debentures will not, so okay, assume that existing equity shares are 100. So only 100 will be taken into consideration in basic EPS. However, when I compute diluted EPS, these 2 equity shares are potential equity shares and they also should be taken in the denominator. You get that? And they will be taken into consideration as if they were issued at the beginning of the period. They will be issued at the, assume that they were issued at the beginning of the period and they will be included in the denominator. So that's what I told you here. You get that? Now let me discuss with respect to employee stock option plan. But before that, one more tiny little discussion. Concentrate. It goes like this. Okay. Ordinary shares, potential shares. If it is ordinary shares, it will be considered in basic EPS. If it is potential shares, it will be considered in diluted EPS. My another important point is ordinary shares are included in diluted EPS computation also. Come back here, see, ordinary shares are included in diluted EPS computation also. But these potential shares are considered only in diluted EPS. So concentrate, potential shares are included in diluted EPS only, whereas ordinary shares are included in the denominator of basic EPS as well as diluted EPS. Now this opens a very interesting discussion as to, okay, I'll write it in red. What if potential equity shares are converted into ordinary shares during the year? What do we do? At the beginning of the year, it is potential equity share. In the middle of the year, it gets converted to equity share. So at the end of the year, it is equity share. Now tell me, will we include it in basic EPS and diluted EPS, or will we include it only in basic EPS? That's the question. I hope you understood the question. I'll repeat it. Now, beginning of the year, there is a potential equity share. At the end of, in between the year, it gets converted into equity share. So beginning, potential equity share. Middle of the year, it gets converted to equity share. End of the year, it is an equity share. Now, when we compute EPS, will we take it into consideration only in basic EPS, or will we taking into consideration in basic EPS as well as diluted EPS? So this is my question. You got it? So let me write this. Okay, this is an year timeline. Beginning, end. I'll write the dates also. 1st of April, maybe I'll assume this to be 31st of December. Okay, if you want years, 19 and 31st of March 2020. So if you want months wise, I can write it here. So this is 9 months, this is 3 months. Yeah, so from this date to this date, it is convertible debentures, and on this date, debentures converted to equity shares, and from this date to this date, equity shares. Now how do we deal with this? Remember the point that I told you. For this phase, it is convertible debentures. Whenever it is convertible debentures, it is potential ordinary share, and here it is actually ordinary share only. So the answer is simple. If it is potential share, where would it be used? Used only in computation of diluted EPS computation only. So it will be considered in the diluted EPS or dilutive EPS computation only. However, if it is ordinary share, then what will happen? Basic EPS as well as diluted EPS, because once it becomes ordinary share, it is there in the denominator of diluted EPS also, the first part. If it is basic EPS, we would have considered only this part. If it is basic EPS, we would have considered only this. If it is diluted, we take this plus this, whereas this is there, no, this ordinary share, so I will take this here as well. So that's a very interesting discussion. There can be questions on this in the examination, so please be prepared for this. So now what we've done is, in this discussion, we're done with convertible debentures, preference shares. Now we'll discuss with regard to employee stock option plan. Come on, let us go discuss with regard to employee stock option plan. No. Employee stock option plan. So you give an option to your employees to convert or to basically buy the shares in the company. You get that? So these options can be vested options, can be unvested options. What do you mean by vested? You should have been knowing this by now. Yeah, if not, don't worry. Vested options basically mean that these options are no more options, they're right. There is an exercise of option, so they can be converted into shares. So those are vested options. So if they are vested options, they become ordinary shares. They become ordinary shares. So once they are ordinary shares, what do? We take them in basic EPS and diluted EPS. Yeah, considered in both the computations. Considered in both the computations in denominator. Now, how about unvested? Now, when the shares are unvested, there is supposed to be, they will get shares, but on happening or non-happening of a certain act, that is fulfillment of conditions. You get that? So it can be two things. It can be based on terms, or it can be based on performance. Yeah, it can be performance based, or it can be terms based. You get that? And this terms based, it should be definitely fixed and determinable. This term should be fixed and this term should be determinable. So if these terms are fixed and determinable, then what will happen? These will be considered as potential shares. Potential ordinary shares. They will be considered as potential ordinary shares. Then we need to check. What should we check? If dilutive. Check if they are dilutive. Usually they will be dilutive. Okay. If dilutive, then what do? Consider in diluted EPS computation. So ESOP, two options. Number one, vested, unvested. If it is vested, it is ordinary shares taken into consideration in both basic as well as diluted EPS. If it is unvested, then we need to check if it is terms based or performance based. Once it is terms based, there should be fixed and determinable terms, and if the terms are fixed and determinable, then it is potential equity shares or potential ordinary shares. When it is potential ordinary shares, we should check if it is dilutive. The moment we know that it is dilutive, it will be considered in the computation of our dilutive. However, if it is performance based, based on performance, then it will be treated on contingently issuable shares. So it will be treated as contingently issuable. So what is contingently issuable shares? That's a separate discussion. We'll discuss it separately. I'll discuss it separately, so don't worry for now. So if it is performance based, it is contingently issuable based on the fulfillment of those conditions. So that will see it as a separate point only, like options and warrants. Done. So you understood this part, but however there are a couple of important things that we need to note. Contingency on vesting. If there is any contingency on vesting, ignore. If there is any contingency on vesting, what should we do? Ignore it. Don't consider it. And the next point, with respect to weighted average. So from when do we take weighted average? Okay, assume grant date to be at the beginning of the year. Okay, fine, I'll write it. For weighted average, assume options are outstanding on grant date. So the date on which the options were granted, that day itself is the outstanding date, and we start computing or we start counting the time for weighted average from that date all by itself. So we're done with this ESOP by now, but we need to discuss this contingently issuable shares. Shall we discuss contingently issuable shares now? Let us discuss contingently issuable shares now. As the name says, these shares are issuable based on some contingency, based on some event. Now I'll tell you, I'll issue shares to you if it rains. So it's dependent upon some event. If it rains, I'll issue shares. If not, no. Similarly, it will not be like that. Just an example is that. Okay. So contingently issuable, it should be based on some conditions. So what will it be based on? Conditions. Definitely such conditions will not be raining or India winning match or RCB winning the cup this time. Isala cup nam the IPL is also announced. So if it is something of that sort, that's not counted. So conditions will usually be profit. If the company makes so much profit, then I'll issue shares to you. Or if the company's share price becomes so much, then I'll issue shares to you. If the company's share price becomes 1,500, then I'll issue bonus shares to you. Or something, or a company will issue shares to proprietors or some managerial person or something of that sort. So it should be based on some conditions. Employees also, they can tell, no, similar to bonus. So if the company makes good profit, company will give bonus, isn't it? Similarly, company will tell, if my profits become this much point or this much of profits, then I'll issue shares to all the managerial personnel and the employees. Or if my share price becomes so much in the stock market, it's profit, isn't it? Then I'll start giving you free shares or something like that. You get that? So if these conditions are fulfilled and the conditions are not fulfilled. If the conditions are fulfilled, then what will happen? Then they become ordinary shares. Then what will it be? Included in what? Basic EPS and diluted EPS. It is not potential share. If it is potential share, it will be included only in what is a diluted EPS. It is ordinary share, isn't it? It is ordinary share. So it will be included in basic EPS and diluted EPS. It is assumed to be issued. If the conditions are fulfilled, do you get my point? Now assume the condition was 100 crores profit. 100 crores profit is crossed. The company has not yet issued shares. It is not potential equity shares. It is companies under the obligation to issue. So we'll assume the shares have been issued and you compute your EPS. And basic EPS will include those shares. You get that? Those shares are assumed to be issued. You get what I'm trying to tell? Because you're obligated, because you always self promised and you have what is it, crossed that condition and the conditions are fulfilled. Done, guys. You get that? When the conditions are not issued, they are not shares at all. They are not shares at all. Conditions are not fulfilled and they will not be taken into consideration into basic or diluted EPS. You get that? Not shares at all. Don't worry, be happy. Done. Now I told you about these conditions. Now these conditions are not for the current year. These conditions are for the next period, or these conditions are for an upcoming reporting period. How do we handle it? Let us see that. Ouch. Or for, or beyond, or for after reporting period. So the conditions are neither fulfilled nor destroyed. Like it is supposed to be fulfilled at a later date. You get what I'm trying to tell? That is, conditions are based on future period. Then how do we handle it? These conditions will include two things, isn't it? Number one, it will be profit. Number two, it will be price. Now let us handle them in detail. Conditions on future profit, future price. When I say future price, I am referring to market price. If it is based on this future profit ka whatever is there, it will be fulfilled in the future. So as of now we don't know. So this is a potential ordinary share. So is this. Oh, I can write it here in the middle only. It would be potential ordinary share. This would be used in computation what? Diluted EPS. Okay, I'll write completely used in computation of. Oh, I can write it completely. Used in computation of diluted EPS. And when I talk about this future profit, we're referring to period after reporting period. When I talk about future price, it is at the end of contingent period. However, we cannot straight away take it into computation of diluted EPS. You get that? Okay. Used in after checking if they are dilutive. So we'll straight away not take them. So these contingently issuable securities will check if they are dilutive in nature. If they are dilutive in nature, only to the extent they are dilutive in nature will be taken into consideration in dilutive EPS. Because I've been repeating it to you from the beginning that only dilutive potential shares are considered in dilutive EPS. If it is anti-dilutive in nature, it is completely ignored and not taken into consideration of this dilutive EPS. So if I go back to potential shares, we're done with this ESOP, we're done with options, warrants also. So now we have to discuss the last point, that is contracts to be settled by issue of shares. So if there are any contracts with shares as consideration. Yeah, then those shares which were promised by you, that you told you will issue them, yeah, these shares are called as potential shares. You might have to issue them and they will be considered to be considered in computation of dilutive EPS. You get that? However, we would have to check for dilutiveness. If it is dilutive in nature, only then it will be considered in our diluted EPS. And it is assumed to be issued at the beginning of the year. So that's the assumption that we need to make. It is assumed that it is issued at the beginning of the year and we'll compute that. That calls an end for our diluted EPS, but I need to tell you a couple of important points. So please note this. And this is with respect to change. This is with respect to change. What if things have changed? Now you have contingently issuable shares, okay, or I can write it as, or you have convertible debentures or preference shares. With respect to this, there can be some change. What has changed? With respect to contingently issuable shares, what do you say? Assumptions have changed. Or with respect to convertible debentures, terms have changed. So whenever these terms have changed, and this has changed during the year, changed during the year. When these have changed during the year, then what we would do? Basic EPS and diluted EPS for current year will include such changes. Am I right? At the end of there, we'll redraft everything, and after including those changes, it is done. So, however, for the previous year, we would have not taken into consideration these changes. So, what should we do? We should do retrospective computation. Meaning, assume I had promised 10 debentures के लिए 1 equity share. Yeah. So in the last year, what did I do? I took potential shares as 10 debentures के लिए 1, 10,000 debentures के लिए 1,000 equity shares. But during this year, the conversion rate has changed. I promised my debenture holders, boss, okay, I'll give you for every 5 debentures 1 equity share. So now the rate has doubled. So for the current year, such basic EPS and diluted EPS is corrected. But for the previous period, I need to go back and change my diluted EPS, taking the additional potential shares. You get that? Same with respect to basic EPS also for contingently issuable shares. Now point number 2. This is with respect to bonus and what do you say, split and consolidation. Bonus issue, share split, or what do you say, consolidation or reverse split. And all this, if it has happened during the year. If it has happened during the year, then what will happen? Basic and diluted EPS of current year will include such issue. I mean, it will include such issue. But what about previous year? We need to do retrospective inclusion. So we need to go back to previous year, and that previous year denominator should also be changed. Now whenever bonus issue is made, or share split is made, or consolidation or reverse split is made, I told you that it will require no consideration. It is assumed to have happened at the beginning of the year, and we do it from the earliest possible reporting date. That earliest possible reporting date is not the beginning of current year. It should be beginning of the earliest reporting date, the previous year or the previous to previous year, whatever is there in the comparative column. So it is assumed that it is not done at the beginning of current year. It is assumed that it is done at the beginning of the previous year only. So you go to the first date of previous year. From that date I will compute it. From that date I will take it to the denominator. So previous year's diluted EPS also should be recomputed as of this year. That's the change dealing. Now let me talk about the last part, that is the presentation with respect to EPS thing. The last part of the standard. I know this is gone a little longer than usual, but you would have to kindly bear with me. If diluted EPS is computed for current year, then it to be computed for all reporting periods. Now current year we computed diluted EPS. We cannot stop there. We need to compute it for all the reporting periods, that is previous year, or if there is 3 comparatives, all the years. You get that? Next one. Dilutive EPS to be computed even if, what do you say, equity shares or ordinary shares is equal to okay, even if potential equity shares is equal to 0, that is basic EPS is equal to diluted EPS. You get that? Because of this potential equity shares being 0, basic EPS is equal to diluted EPS. Still diluted EPS is to be computed. And the next thing is diluted EPS to be computed separately for discontinuing operations. See, if you have continuing operations, discontinuing operations as a separate column, you have to compute diluted EPS for discontinuing operations separately, even if it is negative. Even if it is negative, you would have to still compute it. So basically it would look like this. So we'll have continuing operations, discontinuing operations, current year. Then I'll have previous year. In the previous year also I'll have continuing operations, discontinuing operations. And for each of it I would have to compute basic EPS, diluted EPS to be computed separately. If in case basic EPS and diluted EPS same, assume that it is 10, so I'll write 10 like this. You need not write as separate column. If it is different, then you would have to write it as separate column item. So it has to be computed for every item. Yeah, continuing operations के लिए basic EPS current year, and discontinuing operations के लिए current year how much is diluted EPS. And for the previous year also we need to compute the for continuing operations and for discontinuing operations basic and diluted EPS separately. So this is the discussion with regard to our entire EPS, diluted EPS, as well as the other one. I finished it. So let me come back here and then tick this part. So we're done with the diluted EPS also. If I have to take you to the slide 1 also, so we're done with this. So this is the discussion with regard to EPS. So we'll see you in the next video in a different standard. I'm sorry that this video went a little longer than usual of our usual time width of 20 to 35 minutes. So this was, I didn't want to make it 4 sessions basically with regard to EPS. So that's the reason. So see you all in the next video with a different standard. Till then, stay in the game.